Rupee has been in a sort of free fall. It has caused a lot of anxiety to the RBI, to the government, to business agents, to economic agents, and people are still speculating as to where the rupee is going to end. The rupee has been the worst performing currency, the Indian rupee, even in 2025. It has been the worst performing, probably among the worst performing currencies in 2026 so far.
Irony, Venu, as you said, this year or last year was one of the worst performing years for the Indian currency rupee, and it became one of the best years for the RBI in terms of their trading profits.
RBI recently transferred a lot of those profits, in fact a huge number, unprecedented 2.8 lakh crore to the center as dividend. That there is something wrong in the way the Indian system operates as a whole, the policy system, the regulatory system, tax system, all put together, that it does not create enough of an incentive for foreign capital to come and stay in India for a long time. You know, General Motors left India, Ford Motors left India, Harley Davidson left India, and auto companies typically they go and to various big markets, and they go there almost like to work permanently, stay there and expand the markets permanently. But in India, we've seen a lot of exits.
We have to find out why is this long-term greenfield, sticky, patient FDI. We need long-term and sticky and patient FDI to stay here. Not private, as you said, there's the increasing flow of private equity.
Would you characterize India's external sector today as very vulnerable? Also in the context of the no resolution of US-Iran war, and even if there is resolution, many experts saying that it will take 7-8 months for things to normalize in terms of regular flow of oil, gas, LPG, fertilizer traffic.
Now we have the fertilizer season coming. As you know, despite 70 years or so many decades, we still are dependent for almost 1/3 or more than 1/3 of our fertilizer usage is imports. Fertilizer is key to India's agriculture production, and we might be this extended impact of the war, the Iran war, is that there may be fertilizer price spikes as well as shortages because quantities, unless we manage to source it from some other place. Plus, it will have a fiscal impact because we still subsidize fertilizer in a big way.
Hello and welcome to this special conversation on the wire. And today we will talk about something which has caused a lot of anxiety to a lot of people, the government, business people, to generally all those who are involved in any economic activity, and that is it is the volatility that we have been seeing in the rupee's exchange rate, especially post the US-Iran war. Not just volatility, the rupee has been in a sort of free fall, and it has caused a lot of anxiety to the RBI, to the government, to business agents, to economic agents, and people are still speculating as to where the rupee is going to end. It has been weakening pretty rapidly, and not just post the US-Iran war. The rupee has been the worst performing currency, the Indian rupee, even in 2025. It has been the worst performing, probably among the worst performing currencies in 2026 so far. And one may recall that the economic survey a few months ago had explicitly mentioned that the Indian rupee was punching way below its weight. It spoke about a twin set of problems. One is the rupee was punching way below its weight, and the flip side of it, chief economic advisor actually also said that a special study needs to be done to understand why is foreign investment not coming into India. or running away from India. And of course, these trends have got exacerbated after the US-Iran war. So to discuss this, we have with us a very eminent economist who's written a lot in recent weeks on the subject. Ajit Ranade, who the former vice chancellor of the Gokhale Institute of Politics and Economics, and Ajit is the right person to talk to because he, besides his academic credentials, he's also worked in the private sector. He was chief economist with the Birla Group for a long time, so he understands how the other side also works, the business, how businesses perceive, the currency dynamics. So welcome to our show, Ajit. Thanks for coming to our to us on such a short notice. So
thank you, Ventu, for inviting and your kind words of introduction.
Ajit, just to open the conversation, can you tell us, you wrote two recent columns, one in the Tribune and another one in a newspaper, where you particularly expressed some worry, anxiety over the way, number one, the way the rupee was going, and how you also spoke about RBI's management of the currency. And in particular, you pointed out the fact that the weakening of the rupee since last year has caused RBI to make a lot of profits because RBI has been selling dollars to defend the rupee. So when RBI's reserves are about 70% are in dollars and other hard currencies like euro, etc., and in gold also. So when all these assets were appreciating against the rupees, in the meanwhile, when RBI was selling dollars, it was actually making profits. It was essentially making profits out of a weakening rupee. And RBI recently transferred a lot of those profits, in fact, a huge number, unprecedented 2.8 lakh crore, to the center as dividend to actually plug its fiscal deficit. Now, you have commented on this, on how a weakening rupee is making RBI earn profits, and which is in turn being used to cover the fiscal gap. And you have said that this is not a healthy practice. Can you explain this?
Yeah, Venu, so the thing is like this, that the Reserve Bank of India is the monetary authority and is primarily responsible for conducting monetary policy. And the fiscal policy is the responsibility of the Government of India. So typically fiscal policy is about budgets and taxation and revenues for the government, and monetary policy is about interest rates, exchange rate management, credit flows, and stability of the financial sector.
Yeah.
So one thing that I was observing is that not just this year, but for the last few years, the surplus that is transferred from the RBI annually from the RBI, the monetary authority, to the union government. And remember that this money is not shareable. It's not part of the divisible pool of taxes which are shared with the states. This goes to the union government. That has become a very significant part of the union revenues.
Yeah.
It's close to 8% now. Yeah. And in fact, it's also reflected in the budget. So it's in the beginning of the year when the finance minister presents the budget, you find that item there. So it's almost like become a standard practice. Now, it is not, by the way, even if the rupee was, just for the sake of discussion, we can say, even if the rupee was depreciating, it does not automatically mean that the RBI has to make profits. It happens only when the RBI tries to defend a falling rupee.
Yeah.
So let's say, so it keeps on defending. So first of all, it accumulates dollars because of, it's like I guess it's like an insurance. You need to have dollars in case of sudden flights. So it buys dollars, let's say at 84, and it then sells $100 billion out of its precious stock of foreign exchange at 94. So the 10 rupee drop from 84 to 94 multiplied by $100 billion is 1,000 billion rupees, which is 1 lakh crore straight away.
Yeah.
And since the rupee has been falling rapidly, plus the fact that the RBI has been selling, these two together is generating profits, and those profits are getting transferred to the union government. So it's creating a kind of a perverse incentive, as if that you keep selling dollars from the stock of foreign exchange, which, by the way, we have to have. It's like the dollar is an external currency for us. We need to have a stock of foreign exchange to defend against sudden stops and other liabilities. But we are selling 100 billion of that, which is straight away becoming a fiscal resource. So that was the starting point. So I was concerned that this number is actually, it's just last 3-4 years, it's just been going up, and every year is a record high. This year is almost 2.9 trillion rupees.
Yeah.
Now, just to finish that point, they say that this is not illegal, because there is an economic capital framework, economic risk capital framework, which was sort of decided by the Bimal Jalan Committee in 2019. That was a contentious issue in itself. But anyway, and they said that the RBI should only keep something like 6.5 or 7% of its balance sheet, and whatever surplus is there above that, it should compulsorily transfer to the government. Now, I don't know whether one should examine that, even at a deeper level, but I'm just saying, so the RBI would happily defend and saying, no, we are not doing anything illegal. But I think it is creating a perverse incentive for becoming a fiscal stabilizer.
Yeah. So you just said, Ajit, that this year has been the highest ever transfer from RBI, its profits by selling that they've made by selling dollars in the open market. The rupee profits that they've accumulated. It's a record transfer this year. As you said, it's 8% of the total revenue, then it's probably about 17-18% of the fiscal deficit itself, the total.
That's right? Yeah.
Now, do you recall what was this, say, 5, 7, 8 years ago, before Jalan Committee came up with this framework? Would it have been less than, say, 2-3% of the revenues?
It used to be. I remember it was about 50,000 crores. So it's let's say almost $3 trillion. So it's gone up 6 times, sixfold.
Sixfold. Okay.
6 times in about 7-8 years. So it's pretty. I don't think the nominal GDP of the country. Normally, the balance sheet of the RBI should grow at a commensurate rate, roughly equal to nominal GDP of the country. So you don't have monetary extraordinary expansion. So I don't think we were not like as bloated as some other central banks did after the 2008 crisis. Therefore, this dividend transfer is even more remarkable.
Also, Ajit, I read an article that Dr. Venugopal Reddy, one of the best central bank governors that we've had, he wrote in the EPW in 2024, where he explicitly says that profits made out of such volatility in the currency and such weakness in the currency should be the RBI should be very, very cautious in transferring it to the center, and he argued that by doing this, the RBI is effectively converting a hard budget constraint into a soft one, isn't it? So,
Dr. Reddy, of course, is absolutely right that the dollars that come into India, the dollars that come in are not an export surplus like all other East Asian neighbors. Large countries, South Korea, Taiwan, China, Japan, all their dollar accumulation, they also hold large stocks of foreign exchange, namely dollars. But their foreign exchange,
it's their earnings. It's their actual.
But it is actually export surpluses. We have perennially been a deficit country on the trade account and the current account. So if we have surplus dollars coming in, it's because of balance of payments, and they come in because of external commercial borrowings, foreign direct investment, private equity, and so on and so forth. So actually, that has to be treated very carefully.
Which is the nature of the irony.
And the irony, Venu, as you said, this year or last year was one of the worst performing years for the Indian currency rupee, and it became one of the best years for the RBI in terms of their trading profits.
So are you suggesting, Ajit? I mean, it follows from this logic that you just talked about, and what Dr. Venugopal Reddy had also argued in that article, that there could be a need to review this Jalan Committee recommendation itself, because probably the Jalan Committee recommendation did not foresee this possibility that RBI which has accumulated huge amount of dollars. It was $700 billion at the beginning of this year, and most of it in the nature of liability, as you said. These are all external commercial borrowings brought in, foreign borrowings, and FDI, which also are also in the nature of liability, because equity eventually equity is also on the comes on the liability side of the balance sheet, right? So do you think that Jalan probably did not foresee such a situation where the rupee could keep getting buffeted, and paradoxically the RBI would make a lot of money selling dollars, and then transfer all that to the center, making them fiscally complacent at one level, right?
Yeah, I mean, it's becoming like a treasurer to the union government. Absolutely, that. First of all, one point is that the Jalan Committee recommendations were X% of RBI's balance sheet. Now, this year, the balance sheet has ballooned also partly because the gold has been revalued. Gold prices have gone up by 50 or 100%. And that reflects in a bigger balance sheet for the RBI. Now, if you take 6% of that bigger balance sheet, much of it has happened because of gold. And yet you are able to take away the surplus. That's one point. Secondly, right after 2019, or a couple of years later, we have seen this very fast growth of outbound FDI. So while inbound FDI was $80 billion even last year and so on, but net FDI has fallen drastically down to nearly zero, and there was a danger that it may go into negative territory.
Yeah.
Now, this is not something I don't think the RBI and Jalan Committee contemplated. We always thought that we'll get 1 or 2% of GDP as.
You're right. This could never have been anticipated by them.
Yeah, and then on top of it, so we should look at the granular picture. What are the components of this outbound FDI? There are, of course, Indian companies buying abroad. So if they're owning assets abroad, that's not a bad thing. Then there are Indians, sending money on LRS. But increasingly, there are exits of major marquee names out of India, starting with Wholesale or Citibank, which had a retail banking network for almost 100 years. So I've listed some of those company names, as you know, in my article. So we have to examine why Whirlpool, then of course the IPO listing of Hyundai, I think. Some of these are big names. Why do they want to cash out and leave?
Ajit, here, I want to come in here. You mentioned this, and you also argue in your article that there is something wrong in the way the Indian system operates as a whole, the policy system, the regulatory system, tax system, all put together, that it does not create enough of an incentive for foreign capital to come and stay in India for a long time. As you said, you named all the marquee companies. They've all come and left India. General Motors left India, Ford Motors left India, Harley Davidson left India, and auto companies typically they go in to various big markets, and they go there almost like to work permanently, stay there and expand the markets permanently. But in India, we've seen a lot of exits, not just as you said, cement companies. We have seen wholesale, metro cash and carry company, etc. What could be the reason why big companies, except in the area of let's say tech, let's say Facebook and Microsoft and these other companies, Amazon and all are here, but in manufacturing, India, people are just leaving India. What could be the reason?
Of course, there are a couple of things. By the way, not to forget that Tesla, which is such a big announcement, now they recently have announced that they're not going to build a factory here. So, not to forget that Google, Meta, and all have put in money. Google has announced $15 billion in Andhra Pradesh and so on. But it's true that, one charitable explanation could be that these foreign companies are getting outcompeted by the Indian counterparts, and therefore they are just, closing shop. But I think, probably the reality is something different. We have to find out why is this long-term greenfield, sticky, patient FDI. We need long-term and sticky and patient FDI to stay here. Not private, as you said, there's the increasing flow of private equity. Now, private equity is counted as FDI. But remember, they have a 10-year, the clause says that after it's basically long-term debt disguised as equity investment. So it is
Yeah.
not as firm and as firmly rooted in India as the regular greenfield FDI. Why is
Yeah.
more of that not coming in? I mean, this trend, they say that perhaps the productivity of capital is higher. I don't know, maybe the nature of the economy, but I think it's a serious matter which requires, and this is not just me. I mean, many people have commented that the big challenge right now is private sector investment as a proportion of GDP, whether private sector, whether domestic or foreign. We need to substantially increase it, and we need to increase it in areas and in a manner where it is sticky, not just a flight. Other, by the way, things that have happened is the IPOs. Last 3-4 years we have seen, and SEBI has commented on this, that 60 to 70% of the IPO proceeds are simply going to cash out the early investors.
Yeah.
That money is not going in as fresh investment into the company. It's the
Yeah.
early guys who are cashing out. So the retail guys who come in, they're actually, kind of subsidizing the profits of the exiters. Same thing I suspect is happening with the retail SIP kind of investment. See, the AMFI, the Association of Mutual Funds of India, they had run a very successful campaign for many years of SIP hai to sahi, mutual fund sahi, which is a good thing, and it is deepening the financialization of savings and so on and so forth. But at a rate of 20 to 30,000 crores of SIP money coming into the stock market, but at the same time, I think something like $40 billion of FII money has left India in the last 2 years.
There's one,
and because of the SIP money, Indian stock market continues to remain expensive. And it's now this year, MSCI, according to the MSCI index, emerging markets, MSCI, Morgan Stanley Capital Index, emerging markets, for the last 24 months, India is down minus 10% and MSCI is plus 57%. So, so it is the MSCI investors are finding India expensive because the domestic investors are propping up. So I'm just thinking whether this is a way of the retail investors at large in a diffused way actually generating profits for the exiters. I mean, these are just questions. You see, these need.
No, you're so right, Ajit. In fact, a very senior fund manager, Shankar Sharma, has, in a kind of rhetorical sort of way, he has said that the Indian investor is just preparing ground for foreign FIIs to exit. He says the Dharavi investors are enriching the Manhattan people who had invested in India and are moving out, and the domestic SIP investors are actually facilitating.
The profits of Jane Street are so big that they triggered a scrutiny by SEBI. But these are questions, I mean, I'm not saying that Indians savings should not deepen the financialization of financial sector. We need to have financial component of savings to increase as aggregate savings of the economy. Macro savings are about 25-30%, and we need to have an increasing proportion. But we need to find out a way that it doesn't end up just like a reward for foreigners to exit and not come back.
Also, but coming to Ajit, coming to the larger question that you raised about private investment, India's private investment to GDP ratio used to be at the peak, 2007-8. It used to be around 18%, 17-18% of GDP. Now it's come down to, by some measure, about 11%. Why is two things? Huge private investment stagnation. Also, there is a competitiveness issue. Economists like Shankaracharya have been writing that India's merchandise exports have hardly grown in the last, say, 10, 12 years. They've been growing at maybe 1.5%. Of course, the government tries to, present a combined picture of services and merchandise. But if you look at merchandise separately, which is linked to manufacturing, there is a competitiveness issue. And all the stock markets that are going up today, as you just said, they're all achieving manufacturing excellence in some field or the other, some new field, maybe semiconductor chips, Taiwan, Korea, or maybe people like Brazil and all countries like, because of commodities. But where does India stand? There is lack of private investment, there's lack of manufacturing competitiveness, and stagnation in exports. So will this and with FDI also not slowing down, where do you think our external sector is headed? I wanted to just give us a comprehensive view of this.
Yeah, it's definitely a very serious concern. As I said, for 3-4 years in a row, the balance of payment situation for the first time last year, that is 25-26 fiscal year, our BoP turned negative after a long time, minus 30 billion. And some estimates for this year, 26 to 27, it could go down to minus 75 billion dollars. Now, this is unprecedented. BoP. That's because the capital account is also negative, current account. Secondly, remember that the two most important earnings on dollar front, external front, number one is software services. I'm just giving a general software, including everything, GCC is included, something like $220 billion. And remittances are growing so far quite robustly, about $135 billion. So they are in the range of $500 billion, 220 plus 130, 400, 500. It's conceivable if this strength continues to be there, we could reach $500 billion just on these two. But on the rest of it, then we have, of course, petroleum refining, petro products. But otherwise, we have still not been able to sort of take leverage on the labor intensive exports. And what I mean by that is going back to the dollar and capital account. Actually, large companies, when they take import finance or they take external commercial borrowing, they have an interest in having a rupee defended. It's not because they have obligations. India's sovereign $700 billion of foreign exchange reserves, but almost $700 billion of foreign loans. But none of it is sovereign, meaning the government of India's foreign indebtedness, foreign obligations are negligible. Most of it is private sector. So there are large, it's not small MSMEs who have foreign loans. So
the large corporations.
We need to examine, so as I said to you, when we were discussing, there is a deeper issue here that when we try to defend the rupee or sell dollars or make profits in RBI, what is happening to the whole labor intensive export opportunity? I mean, all these latecomers like Vietnam and Bangladesh and even Sri Lanka, they say that the textile story is over, there's automation. But even now, they have $40-50 billion of exports. I mean, Sri Lanka and Bangladesh. Why is India? We are still struggling with energizing our labor-intensive exports. The biggest export is remittances, which is kind of an indirect labor export. Another big export is software services, which is also kind of labor. But we need to do much more on that front. So I think the answer to your question is that it's a worrying situation. How to build external strength. I mean, we might be globalization might be slightly at a slower pace now. It's certain we're not in a complete deglobalization. There are blocks and so on. My favorite example is that China is a $6 trillion consumer economy growing at 3-4%. India doesn't even have. Why can't we have at least? And 140 countries export to China. See, China is not only the biggest exporter in the world; they're also biggest importers. So why can't we have even a 1% share of that? Is $60 billion of exports to China. What does it take to export to China? Now they say that
So Ajit, finally, would you characterize India's external sector today as very vulnerable? Also, in the context of the no resolution of US-Iran war, and even if there is resolution, many experts saying that it will take 7-8 months for things to normalize in terms of regular flow of oil, gas, LPG, fertilizer traffic.
This, as I said, the worrying situation is not only on the FDI and the balance of payments, but the inflation impact due to prices and shortages. We are hearing stories about how there are actually in parts of the country there are shortages of petrol, diesel, or LPG. Perhaps they are not there in bigger cities, so the pinch is not being felt. But that's something worrisome. But now we have the fertilizer season coming. As you know, despite 70 years or so many decades, we still are dependent for almost 1/3 or more than 1/3 of our fertilizer usage is imports. We still are not. I mean, we had this one very successful experiment in Oman. Don't bring in the gas, but just produce the fertilizer and bring it in a joint venture. But that was only solitary success. We should have had many more such things. And fertilizer is key to India's agriculture production, and we might be this extended impact of the war, the Iran war, is that there may be fertilizer price spikes as well as shortages, because quantities, unless we manage to source it from some other place. Plus, it will have a fiscal impact because we still subsidize fertilizer in a big way. Actually, that reform also has been pending for a long time. That how to, rather than subsidizing the product, subsidize the small farmer. How to target the challenge is that they say 40% of India's farming is done by labor. I mean, the landless labor. So how do you, I mean, how do you subsidize the farmer when there are more absentee land? So it's not an easy challenge to crack, but I think we need to substantially address this. Fertilizer subsidies about 2-3 lakh crores now, and this year it's going to be a tough situation. There have been instances, by the way, where fertilizer has to be distributed through police stations now under police protection.
Are you so? Would you characterize this as a perfect storm around the external sector, and where do you see the rupee headed? Can you give your estimate for, say, the year end or something?
So a lot of people have been saying that, hey, this is not 1991, that our reserves were down to zero. This is not 2013, the taper tantrum in the Fragile Five. But I think, even though our GDP outlook, even the IMF is saying and others are saying we may still be about 6 or 6.5%. Inflation is still nowhere near the highs of 2013. Foreign exchange reserves, despite all this sale of dollars, is still at around 650, 625. So on that macro count, it looks as if it's not such a, but I feel that the situation can turn worse very rapidly.
Because so we need to, I think this has not happened because the oil reserves are being drawn down. The real effect of shortage has not, most economists around the world say the real inflation and other stagflationary kind of tendency is not kicked in as yet.
Yes, so there is the equivalent of this, there is this concept called sudden stops. So foreign exchange. So I think something equivalent in the physical world in terms of the dollar shortages, the oil shortages and the fertilizer shortages, we might just suddenly run into a drastic situation, and then we'll have to do rationing or, as I said. So that is something we need to look out for. And that's why I feel it's better to worry now and start building in, rather than just having draconian measures like sell only under police protection or do intensive rationing. And God forbid we have to do something like Sri Lanka. Sri Lanka went into a crisis because of their foreign exchange situation. They had to cut down fertilizer imports drastically. There was a change of government because of that. There were riots because they tried to induce farmers to switch to natural farming or organic farming, but that didn't work. So I don't think it will work in a much larger country like India.
Okay. Thank you very much, Ajit Ranade, for talking to us and giving us time for this conversation. Thank you.
Thank you very much. Thank you.